There we go. All right. Hey, everybody, this is Z, and I'm coming to you from NoVa Notes Meetup, and I have my guest here, Sri Gandla from Fairworth Investments. And what we're going to go over is a little bit about mortgage note investing and the state of the mortgage note industry as it is with this COVID-19. And before we do that, let me tell you a little bit about myself. So again, my name is Ananzi Awana. Everybody calls me Z because it's a whole lot easier to say that than, than my full name. And so I'm currently a DoD contracting officer for the federal government and retired Navy veteran. Did 20 years in the Navy and hold a bachelor's and a master's in education and a master's in public administration, more geared towards federal contracting, which is what I do. Been a real estate investor for a little over 30 years, not in the note space, mortgage note space, but just buy and hold rentals as I moved from duty station to duty station. And started my business in 2018 and got really interested in mortgage note investing. So with that, enough about me. Let me go into a little bit about what a note actually is. So, excuse me.
Do you want to do a full screen so that they can see the screen better?
They can't see that? Let me make that a full.
On the bottom right hand where you see the zoom,
Yeah.
the button, yeah.
Yeah. All right. So hopefully you guys can see that. Oops,
Yes.
a little bit better
A
about
lot
what
better.
a mortgage note is. And so if you ever, to kind of make it simple for those of you who don't know what a mortgage note is, if you ever had took out a mortgage loan on your home, if you own a home and you took out a loan on that home, you signed probably a promissory note. And that promissory note is what secures the your home for the lender, for your bank. And they hold what is called your mortgage note. And so that gives them the right to foreclose on your home should you stop paying on that loan. And so as a mortgage note investor, what we do is we also act as the bank when we buy mortgage notes for the balance owed on your mortgage loan. Sometimes, typically it's at a discount and it's going to depend on some other factors. So like if you're in a buy and hold, you have to realize that as a note investor, you don't own the property, you own the paper. So just wanted to make that distinction as far as mortgage note investing goes. So with that, I'm gonna go ahead and introduce my my guest, Mr. Sri Gandla from Fairworth Investments. And Sri, you can go ahead and introduce yourself and tell us a little bit about you and your expertise here in the mortgage note space.
Sure. Hello, everyone. My name is Sri Gandla. I've been investing in mortgage notes since 2014, in real estate since 2008. So it's not all roses and chocolates, I guess. So back in 2010, I was basically doing. I was a landlord and a lot of doing flips. So back in 2010, I was doing 3 flips when the federal government has announced $8,000 credit, and all 3 of them were with hard money. One of them was the regular crew. I see Dan joined, so Dan can definitely. I think he already knows where I'm going. So basically, what happened is the first property I was using my regular crew. Since I wanted to get the $8,000 credit, I was doing 2 other properties with not my regular crew, and it was 14% interest and 4 points. So by the time, since I was not using my crew for the other 2 rehabs, it did not finish by May 30th, 2010. So I held that property with the hard money loans for more than 12 months because it felt like borrowers just disappeared. from the market. I was able to sell the one property. Other two properties I was not able to sell. So I was in a deep hole. This was back in 2010.
Mhm.
So what do we entrepreneurs do when it doesn't go as planned? We think we are better and we will go after it, right?
Right.
I was looking for more short sales, and that led me to one of the hedge funds that actually, uh, it was listed as a lender, and I was trying to reach out to them, and
Right.
it didn't work out. Then I said, "Yeah, I have few more, um, a few more of this which are not performing. Can you help me with this?" Like, that's not what we do. We sell
Right.
notes, and that's how it
So you didn't
got
know
there.
what notes were at that time, though.
Exactly. But at, it was really, um, how do I put it? Because I had worked in secondary mortgage industry
Hmm.
for two of the biggest players in the market for 8 years.
Right.
So I know all the calculations, all the software. I'm from an IT background. I
Okay.
guess I should have told you that. I have a master's in computer science, master's in
Nice.
telecom, bachelor's in computer science. I have two masters in technical background. So I was building systems for this two big secondary mortgage lenders, wherein how do they handle, you know, uh, I mean, I don't want to go into gory details of
Right.
how Fannie and Freddie buy mortgages, but when they buy mortgages, there's something called a master seller servicer agreement,
Hmm.
which they sign with, any of our regular lenders, Bank of America, Wells, any of them, right? Once they sign this agreement and Bank of America delivers against that contract, so $50 billion of 720 credit, um, this much LTV, and it is in one of the contiguous states, and you package that and deliver loans against each of this contract that they have with, Fannie or Freddie, whichever might be the case.
Hmm.
So I was building systems more towards performing loans. So, Fannie, Freddie performing loans. So whoever knows any software, their whole uh, software applications to manage non-performing notes was an Excel Excel file or an Access database,
Right.
right? So then what happened is they started building this non-performing loan department. So they started selling as bulk REOs to start with. So I was involved when they were building systems to do bulk REOs. So they
Hmm.
divided the whole country into 18 different segments, and they
And you
wanted to
had
sell
all
bulk.
that information, but you didn't know what you were looking
Yeah,
at.
but I didn't know how to use that to actually monetize that info, right? So I was
Wow.
building all that info.
Wow.
So then what I did is some of the rentals, I think I don't know when it was, but I attended a seminar, and I got to know about notes.
Mhm.
So they said, you can actually sell a finance. You want to be a lien lord instead of a landlord.
Right.
I think you're trying to explain being a property owner versus a note owner.
Correct.
So you wanted to jump on the lien lord. Okay, let me look at this. So I started looking that into it, and at that point in time, I had a portfolio over 20 rentals, and I was managing myself, and I had a 2-year-old son, and it was crazy. So I started selling some of my rentals as with owner financing, basically.
Mhm.
I The properties were in Maryland, so which can be a little time consuming to foreclose.
Right.
So I had to actually sell it on a CFD, um, contract for deed, instead of actually selling it with a mortgage and a note.
Mhm.
So that's how I got introduced to the note space with my own properties. Right, I was seller financing and selling the properties.
Mhm. Mhm.
So when Z got stuck with the property, I think she sold it now. So I
Yes,
could use that knowledge to help her out how she could actually structure
absolutely.
owner financing and still
Right.
make a good buck at the end.
Yeah, it was good. It was
So as I told you, so this hedge fund got me. They said, "Can I buy notes?" And I'm like, have you ever worked on it? Do you know how to do it? Uh, I was all over the place, I guess. 2014, come 2014, I did buy some notes before that, but 2014, I've actually got in touch with Fuquan Bilal.
mm,
So he used to do this 3 month. It was crazy. I was living in Virginia, and Fuquan is in New Jersey, North Jersey.
yeah.
So I used to drive from here Tuesday, stay in a hotel on Tuesday, Wednesday, Thursday. So the classes were on Tuesday night and Thursday night for 3 months,
Oh,
straight
wow.
shot. So for 3 months, I was driving from Tuesday to Thursday to go there and
To
attend.
learn how to do notes.
Yes, yes.
Okay.
So it was a 3 month process. I would say that is the best training I ever received. Like I mean, 3 months you're seeing everything basically, right?
Right.
Everything from what a note is, what the document is, how you record assignments, how do you see if the note actually makes profit, what are the different exit strategies, how do you make money
Mm-hmm.
from each exit strategy,
That's
how do
cool.
you pick your note. So basically, I think even Dan might have mentioned this. He would buy an asset based on the uh, if you're happy with the least amount of return out of all the exit strategies that you have. So if you
Right.
note, if I have 6 exit strategies, the worst return that I'm going to get is 25% out of the all 6. Then
Absolutely.
I would go in and pick that note, right?
Yeah.
I mean, that's what I use basically.
And Dan, you can jump in there. I think I've unmuted you, so if you
Oh, yeah.
wanted to jump in at all.
Hey Dan, how are you?
Good. How are you? It's good to see you. Yeah, I'm happy to jump in, but Sri's doing an awesome job. And I'm enjoying
Yeah.
listening to what his history, his story. I didn't get to hear it before.
So after that, Fuquan basically deals with non-performing seconds. I did mostly seconds, and eventually some of that product got lesser and lesser in the market. So I jumped
Mhm.
in buying non-performing first. So buy first, seconds. There's one other aspect of my business where I buy properties which are above 750K, basically that qualify for jumbo and super jumbo loans.
Right.
I buy it on a contract for deed from the owner, and actually I wrap the notes and sell it to a different buyer because generally the buyer pool in that particular segment of the market is much lesser
Oh.
because it's harder to qualify. So I'll show some of the slides what's happening right now in the market if I can take the control.
Mm-hmm. Let me see if I can get that to you. Oh man. Okay, I don't
I think
see
if
it.
you stop sharing, then I can share my screen, I guess.
Right, let me do that. I don't know. Okay, let's see if you can share yours. Will it allow you?
Yeah, yeah.
Okay,
One
good.
second.
Hey Dan.
Hi, how are you?
I'm
How's
good.
everything?
I'm good. Oh, somebody's trying to get in. Let me.
Let them in.
So I presented this in one of my recent meetups. I do 2 meetups once a month. One in Virginia, one in Maryland, specific to node investing. Um, so I was talking about what's happening with COVID-19. I'm not an expert. I'm just these are my thoughts based on what I've seen in the past.
Right.
So unemployment claims, right? So if you see this starting March 9th, it jumped up by, you can see the percentage, right? So this has actually gone up to 20 million now. So when I did the slides, 6.4 million unemployment claims were filed by the first week of probably, first week of April or
Yeah, I think
first
we're
of
at
April.
22 million now.
Yeah, yeah, yeah.
Crazy.
So I was specifically talking about how it actually impacts the mortgage industry. I'm not going to go into the gory details,
Yeah.
but what this essentially means is there's going to be more product coming up in the market. So there are two waves of product that is coming in. So all the note holders, this I'm talking about hedge funds higher up the food chain. I guess I need to go into that. So when you talk about a mortgage industry, right? So what happens is the Bank of America, Wells Fargo, Fannie, Freddie, all of this, sell it to, a bigger size hedge funds, and those hedge funds sell it to a mid-size hedge funds, and then you buy from them, right? You, in the sense, individual note buyers buy notes from them. So this is the food chain. So higher up you go the food chain, you get it a better pricing, right? But what happens is most of the time you're picking up the whole pool instead of just picking and choosing. You don't have cherry picking allowed. Cherry picking is if you have 20 mortgage notes, let's suppose 20 mortgage notes, I'm just using it for example, there'll be a lot more in it. So 20 mortgage notes, you can't choose, I want the third one, fourth one, fifth one, you buy the whole thing. Higher up the chain you go, you buy the whole thing,
Oh.
right? So what happened is this medium level hedge funds were holding a lot of the seconds and first. Basically, they were releasing in drips, but not you know whole. It was not like a lot of product available in the market. So what I've seen right now is as this COVID-19 hit. So I don't know if it's because of panic selling or they're getting prepared for the upcoming note sales that are going to be available. They started selling those assets. So I have bid since beginning of March till now. I bid on 5 tapes. I didn't win all of them, but I bid on 5 tapes, right? So I'm seeing a lot of product coming in. But the actual product, which is got all product in the sense notes where the borrowers are getting impacted, that product will probably see about 18 months, 18 months to 24 months, because there's an incubation period where they have to go through this, they miss the payments, and the banks have to go through the process before they decide what to sell. But I'm expecting some product to come in, you know.
And so even with that, don't you think that with all of the stays on foreclosures and the stays on evictions and filings and all of that stuff, that's going to have even more of an impact on when some of these assets show up on the market?
Yeah, absolutely, absolutely. I mean, what we don't know at this point of time is, you know, um, I don't know the exact number right now, but how many people are actually delinquent right now? Because the forbearance is, temporary. What what they're getting is temporary relief of not having to. Borrowers are getting a temporary relief if they have a financial difficulty during COVID-19. They don't have to pay the mortgage payments for a 180 days if it's a federal loan. And each of the bank has a different regulations, right? Bank of America suggested 90 days where they don't have to pay, right? If it's a Fannie, Freddie, VA, or HUD loan, they don't have to pay for 180 days, and they can request for 180 days additional days. But what we don't know is after this 180 days ends, if they are a small business owner, will they be in a position to actually, jump in and
Right.
pay right away, right? It also depends on how the forbearance was structured. So if anyone on the call is a borrower, one of the things that you want to do is when you talk to your bank about a forbearance plan, you want to ask them to put this payments of 3 to 4 months at the back end of the loan, not the fourth month. So you don't make payments for 3 months. And on the fourth month, all 4 months of payment is due,
Yeah.
is not really going to help you, right?
Yeah.
So, if you take anything from this is one clue, one tip you want to use from this webinar, wherein if you do request for a forbearance, ask it for to be put the payment at the back end of the loan, 20 or 30 years, whatever that is, not immediately in the fourth month, right?
Right. I've seen a lot of posts and things like that from borrowers saying that the banks were doing their forbearance where the full payments would be due in the fourth month.
Yeah.
Again, that's another good thing about being a note investor is that as the bank, we can make those
Yep.
changes and modify those note loans and stuff much easier than the large banks can. And, just we're able to work with our borrowers a lot better than
Right.
the banks can.
Right. All right. So this is a graph that is actually showing, um, so I told you about government guaranteed loans, which are Freddie, Fannie, all of those. So there are two types of lenders, right? One is depository, where they have a deposit um, section of business going, like where they have a retail bank. People are coming and depositing funds in there for money market account, checking account. So they have some kind of liquidity. On the other hand, there are some lenders who are non-depositories. So they don't have a deposit, they only lend money. They borrow money from, they have some arrangement with the Fannie Freddie where they sell the loans to Fannie Freddie, but they don't have a retail banking division or any other source where deposits are coming in.
Right.
So those are the ones that are going to get impacted more than the depository institutions. If anyone wants to know why, they can contact me offline, because that's a conversation for
Long.
or I think Z has provided my Facebook link. If you go in there, I did a presentation, went into detail of this about 15 days back, so you can go in and catch that.
And I'll put the slide back up at the end with all your information
Yeah.
and stuff on there.
Yeah. So one of the things that you might want to concentrate is if you want to do owner financing, that market is going to be pretty hard. Uh, the reason being the banks are already tightening the lending guidelines.
Mhm.
JP Morgan Chase announced that you need to have at least 700 score, FICO score, and 20% down. If not, they don't want to lend,
Wow.
right? And one of the things I've seen is jumbo loans, which were already approved, wherein they only ask for 10K, now they're asking for 20K down. And the other is lenders, what they're doing is right before you close, they're actually, if you are a W-2 employee, they're calling your employer and checking, hey, is this person still employed? Can we do this loan? So, they are checking a verification of employment, which is, I never heard of this. This is more
So let me
recent.
ask you this, Sri.
Sure.
So with the seller financing, I know that's a great opportunity, but how do you think that's going to impact a lot of the note investors who are not licensed in certain states?
If you're not licensed, there are two ways to do it, right? Get licensed in the states um, where you have to. So there are different. So if you go to NMLS, type in a national mortgage license, NMLS. If you type in NMLS in Google, you will get the list which states need the license.
Mm-hmm.
So if you want to test the waters and you're not actually want to do it on a long-term basis with owner financing or any mortgage-related um, business, then what you want to do is concentrate in the states where the license is not required. Not all states require license.
Yeah, well, that's obvious, right? Right.
And if, let's suppose, some people like to, I mean, as a note investor, I invest wherever the opportunity is available. I don't stick to my backyard.
Right.
Right. But if some people are, like only specific states they live in and they like to stay in those states, for those folks, what they can do is, if let's suppose for Maryland, right, for example, for that and get the license just for that state. There are, depending on which attorney you talk to, they say it is required. Some attorneys say it is not required in Maryland. I have a debt collector license in Maryland, but it's your call. Talk to your attorney, make the call whether you need the license. But one thing you do want to do is, doesn't matter whether you have license or not. If you are originating the seller financing note, right, you want to use a licensed mortgage RMLO who is licensed in that state to do that. You don't want to qualify yourself unless you are selling to an investor. If the property, the borrower is an owner occupied borrower, then you definitely want to use an RMLO. It's not a whole lot. If you need a originator in any of the 50 states, reach out to me. I can provide the info. It doesn't cost you a lot, probably $1,000 to $1,200. So, and you can ask the borrower to pay it basically as part of the closing costs. So it really doesn't. There's no reason not to use it. Right. There are some states which are weird. Even if you're using a RMLO, you still need that license. Ohio is one of them. They recently changed the laws and they made it a lot tougher to do owner financing now, or even buy notes.
Yeah, so that would be one of the states to avoid for me anyway.
Yeah.
Okay.
Okay, this is talking about credit availability. So this has gone down a lot. What I mean by that is if you look at the conventional loan, see everything is going down basically. The ability to get credit is going down since March. This is jumbo loan. It took a huge nosedive. This is COVID funds. So I was using this to see, how long, what are the potential borrowers which already have mortgages or potential places. Why I think that there'll be a lot of opportunity, right? So as part of I think there are different phases of this CARES Act. This was done when it was done for the first phase of the CARES Act. How are the funds being distributed across different sectors? So small business, obviously, those people are going to get impacted, and that will result in they not paying their mortgages, and that will come into the market. And also, when you go to a traditional bank, right, they look for 2 years of tax returns, even if they have the income later. Let's suppose we get out of this COVID thing, everything, and we come September and they want to buy the house and they have the required down payment, right? But they don't have because if a bank is going to look at your tax returns for the past 2 years and there's a chunk of time in the middle, you're self-employed and you didn't have any income, right? So that's where using the owner financing actually helps you, because you can help the borrower actually get a CFD and buy the property with you owner financing it. You don't have to use your own funds to owner finance. You have to know how to structure the deal. That's it. Then what happens is, that I'm telling you what are the opportunities that are going to come up based on what's going on in the market, right? For the landlords out there, and also note holders, these are some of the jurisdictions that have stopped foreclosure and eviction. So you can't evict or foreclose in these counties for temporary basis. I think most of it is 90 days. Okay, mortgage crisis as I see it, this is not similar to 2008. 2008 loans were given out to borrowers who, specifically did not qualify for a mortgage. If you can breathe, if you can fog a mirror, you could get a mortgage in 2008. Not anymore. So this is a little different. Economy was comparatively better now, but because of the COVID-19, it's a ripple effect, right? Everything started with when CARES Act was given out, right? I mean, it was required at this point of time. I was not really excited about government jumping in back in 2008 to bail out the big banks, but at least this time there's no bank bailout. So that's the good part, because it is actually helping individuals and citizens rather than helping the big institutions, right? Yeah, I'm not going to go into federal buying MBS, right? So basically what Fed is saying is, when Fannie and Freddie increase their guidelines of what mortgages they will buy, right? And also the lenders, what they're going to buy, basically Fed, what they said is to maintain liquidity in the market. They are saying as long as you originate the loans which are conforming loans, we will buy those loans. But I haven't seen any drop in how many mortgages are being approved. I mean, not approved, sorry. How many mortgages are not being approved after COVID-19 started? Yeah, so this is going to impact a lot. And as I stated earlier, I'm hoping to see a lot more trades in the future. I'm already seeing that. But none of what I'm seeing right now is because of the borrowers that went delinquent because of COVID-19, because that's going to be in the pipeline later. Yeah.
So what do you think that as note investors, or even just investors or people who wanting to get into notes right now, what kind of things should they be focused on doing?
Try to see, network with people who are actually doing deals right now, right? Try to network with them and try to understand. So one thing, right? If you are as a any investor, right? If you are looking for cash flow, if you're looking for rental properties, right? You want to make sure there's a 1.75 debt coverage ratio. I used to generally say 1.5. I would actually bump it up to 1.75 right now. Because there's an expectation that the property values will fall. By how much? I don't know. No one knows, I guess. Right. That is from a property perspective. So be conservative. Don't be aggressive, because right until Jan, I was conservative, but comparative to now, I was aggressive compared to how I'm buying right now. I've already seen a price drop in notes that I'm buying. It is by depending on the state, 5 to 10 cents. So if I was buying at 40 cents before, I'm buying it at 30 cents, same note. Yeah, because there is an expectation that the property value will drop. So the equity that actually is covering you is going to be lesser.
Investing it on your second positions.
Yes. Even in the first, right? So if you're assuming your ROI needs to be 25%, and you assume the property is worth 100K right now, you foreclose and you're going to sell. By the time you're ready to sell, it might drop to 80 or 70. right? So you got to adjust. So you got to adjust. You got to adjust the pricing that you buy. Um, and if you have asset, if you're already invested in assets, and if you can get out of it and get to a cash position, try to do that, because there is going to be opportunity coming up. So
That's why
you
I
want.
got with Dan, so I could raise capital. Trying
Right.
to position ourselves to be ready for the opportunities.
So I forgot that I had this slide. So anyway,
Yeah,
you were asking how to prepare, right? This is
right,
an
right.
opportunity, right? If you are into doing direct mail or any kind of marketing, try to reach out to landlords who are not willing to sell it at a price in the past. They might be motivated now, right?
Mhm.
One of the owner financing things that I was talking about is talk to new constructions where it's not, one of the big firms like NV Homes or Pulte or Toll Brothers. Yeah, I mean, you're not going to get bites from them, but new construction from a smaller size builders, right? They will be crunched for this properties selling. Okay, you can use the owner financing with them. Basically, you buy it with owner financing from them, and you can wrap around and sell it with owner financing.
Mhm.
Um, that is going to definitely be an opportunity for sure, right? And landlords who have bought rental properties with the intention that they're going to do Airbnb, wherein they can get a higher rent, and they didn't look at the solid financials of 1.75 debt coverage ratio, assuming if you were to rent that as the regular market, right, instead of Airbnb, right, those landlords will be ready to sell now,
Mhm.
right? I know a lot of landlords bought looking at Airbnb as the rental prospect here, local DMV area.
Mhm.
So you will find some opportunities there. Um, you can buy pre-foreclosures. So if you mail to pre-foreclosure, don't do that in Maryland. Maryland, there's something called PIFALA that actually you can get jail time if you actually send mailers or any kind of marketing to pre-foreclosures, unless you have that. There's some kind of license required. Anyone that is more interested, type in PIFA in Google,
Mhm.
PIFA Maryland, and contact an attorney once you read up. Contact an attorney in that state. They will help you how to actually reach out to the owners.
Wow.
Okay. Owner financing, non-QM mortgages. As I told you, any loan above 750, which is not basically a conforming loan, um, you will have a lot of owner financing opportunity because the sellers will not be able to sell that property. I mean the so there is some kind of marketing which I use with bird dogs. So there are bird dogs that actually bring me properties with our owner financing. So
Mhm.
basically, they market for owners with equity and stuff, and they talk to the owners. Do you have anything else to sell? And if they happen to have a loan that would only qualify for non-QM mortgages, so they are not able to sell, and they bring me the deal, and I joint venture with them to actually um, do the deal, and they get three cash profit centers, basically part of the down payment, monthly cash flow, and the back end payment when the borrower refinances. So that's the owner financing for non-QM
Right.
mortgages.
Right.
For node investors, as I told you, for the past 45 days, I've seen a lot more product than what I've seen in totality for 2019.
Wow.
So there's a lot of product coming in, and um, there are some more to come in the next month or so. So there's a lot of opportunities coming in. Yeah, I told you about the 180 days moratorium. Big hedge funds are selling right now, getting prepared for get in a cash situation so that they can actually be able to purchase in the future.
Mhm.
Oak Tree is one of the bigger funds that is actually opening a new distress fund to be able to buy this debt that is going to come up. So they are
Right.
raising money right now. It's one of the bigger hedge funds that is actually raising money to buy notes. So that's a
And
sign
so
that
then
they're
they'll trickle those notes down to
yeah. Then I
us
mean, if
on
they
the
buy and
bottom.
trickle down, it's going to take time. Yeah, yeah.
Okay. Okay. Very
All
good.
right. Yeah, I was trying to explain in my seminar, what a wraparound mortgage is, how would you actually sell it? But I'll say that for another day.
Another presentation.
Yeah, I think Z already provided a good job of
Fine.
definition. So,
That's fine.
I mean,
Thank
I don't know
you.
if you have
Anybody out there
anyone
have
has any questions. I can.
questions? Yeah. So, Sri, if you can stop sharing yours,
Yeah,
I
let me do that.
will share your contact info. And we'll go back to that. And there is Shri's info there. If anybody wants to get in contact with him, he has a Facebook group as well. And this is being recorded, so you can also come back to it. We already went over the disclaimer. And here is my information. And so if anybody has any questions, go ahead and put it in the chat. And otherwise, I'm not seeing anything. So I want to thank you all for joining me, most especially Sri for taking time out of your day to present on my show and speak for me. And we'll see you out there in Note Land. Y'all have a good one.
Thank you.